Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy, and today we will be talking about what happened in January with the markets and how our portfolios performed, and also give you some thoughts on what's been going on in the economy and what we see moving forward. Cameron, why don't you kick us off with some economic information?
Thank you, Kelly. Obviously, the biggest news that we've seen over the last week has been the Fed and their decision on the federal funds rate. So on January 31st and February 1st, the Fed held their first meeting of 2023. After that meeting, the Federal Open Market Committee, which is made up of a group of Fed presidents, voted to increase their target rate by 25 basis points. For anybody who's been watching the news, you'll understand that the Fed has been aggressively targeting increases in the Fed funds rate to try to stave off inflation. I think the 25 basis points was expected. Some people thought there might be a pause. Some people thought they might go as high as 50, but 25 was kind of the inline consensus. And what was very interesting, and when we did see a rally, was that Jerome Powell, for the first time, really intimated that perhaps they are really starting to see inflation cool, that maybe they can take their foot off the gas. Made no commitments either for or against additional increases, but certainly I think the days of what we saw in 2022 with the 50, 75 basis point increase in the federal funds rate are probably behind us. We're probably getting to a more normalized range of interest rates in the Fed's opinion. So in 2023, we could probably still see another 50 basis points, maybe 225s. But for all intents and purposes right now, unless we really see inflation tick back up, I think we're looking more in the clear in terms of taming inflation, which has been a huge problem ever since the pandemic.
Yeah, I'm in total agreement. Maybe a couple more 25s, probably not much higher. Probably, if you take Powell at his word, they're going to move a couple more times, but not reduce it. There's definitely a strong contingency out there that thinks they'll be reducing interest rates by the end of the year. I'm not really in that camp. I think it's going to be, like he says, higher for longer, meaning, if they get a little bit higher or where they're at, they're just going to keep going and kind of, keep it steady for a while, I would guess, well into 24.
And let's face it, for all of us, the last 15 years, these rates have been historically artificially low, dealing with these certain crises we've had, whether it be the pandemic, whether it be the financial crisis of 2008, 2009. Where we're at right now is very even moderate in terms of long-term inflation,
exactly.
Or long-term historical interest rates. Now, what is interesting is what we're seeing here in the United States is a little counter to what they are still seeing in Europe. February 1st was Wednesday, February 2nd, obviously Thursday. We saw both the Bank of England and the European Central Bank come out with 50 basis point increases. And the European Central Bank already said in March their expectation is to increase another 50 basis points. So obviously Europe is still seeing higher inflation. They've gotten very lucky so far with a mild winter and not having that super shock of energy price soaring. So, it's a tale of two economies right now. The U.S. appears to have this thing under control, moderating. Europe, inflation still is not where they want it to be, and they still plan on in 2023 taking more aggressive action.
And, call it is, we're probably ahead of the game from a global standpoint, which is not unusual, especially with the way the pandemic hit things. The U.S., generally leads the way out. So it's not surprising that, even if the Fed's work is done, European Central Bank, Japanese Central Bank probably still have some work yet to be, ahead of them. So, and I think that's going to continue, moving forward.
Now, what's interesting now is how we're seeing this. Obviously, if the economy is slowing down, that means that inflation should be coming down. If people are out of work, they're less apt to spend. If businesses don't have clarity on the future, they're less apt to spend. So every indication is that we are in a slowing economy. We did see that fourth quarter GDP came in as expected at an annualized rate of 2.9%. According to the Bureau of Economic Analysis, this was from January 26th. We also saw that full year GDP came in at 2.1%, which is really right around kind of the historical average where, for a mature economy like the U.S., that's kind of the good numbers, 2% GDP growth. And then in the first quarter, the Atlanta Fed is projecting, as of February 1st, first quarter GDP to be at 0.7% on an annualized basis. So obviously, that'll tell you if that first quarter number is correct. We are seeing a slowdown. We've also seen a significant amount of layoffs, almost 300,000 jobs in the tech sector. 300,000 jobs have been lost in the tech sector. We're also seeing that kind of go into the traditional economy. We're seeing layoffs from, significant major manufacturers. So it does feel like the economy's slowing, but then all of a sudden today, we get a $517,000 January jobs report from the Bureau of Labor Statistics, which was significantly higher than the 188,000 jobs expected to be created in January. So just a lot of conflicting signals right now.
Yeah, absolutely. A lot of cross currents. Things have definitely been warped since 2020 with the pandemic. The reality is during that, during 2020, a lot of industries faced a recession then, but certain sectors, technology, did very well. And is this, kind of an equalization? And, what is this slowdown really going to look like is the question mark. Do we, actually see a true recession or just kind of a slowdown in, fragmented areas? Mm-hmm. It's looking more and more like that's kind of the scenario we're going into, where the economy growth-wise, we could see some fits and starts. Maybe we have a negative number. Will it last long? The economic history tells us if the consumer is in relatively good shape going into a recession, that has always resulted in a shallow, short recession. Mm-hmm. If the consumer is in rough shape or really, in, a lot of debt, having debt problems going into a recession, that's when recessions are extended and, tend to be a lot rougher. And if you think about it, our two major recessions we had in the last 20 years or 30 years, 01, 02, the market was a big dislocation, but the recession side of it was, fairly short, mm-hmm. versus 08, 09, which was driven by the housing crisis, where that hit the consumer a lot harder because of the trouble people had gotten in with the mortgages and everything.
Bad mortgages, yeah.
That was a lot longer extended recession. And, with the way things have played out with the pandemic and also with all the money, all the stimulus that was created that actually went into the consumer's hands, into small business hands, or, even large business hands, that argues that the consumer is probably in, relatively a lot better shape today than they were in 08, 09, or 07, which, once again, it really looks like this is going to be kind of a different type of recession. If we have recession, maybe it's what they call a soft landing, where we never really hit all those metrics, but there's definitely certain industries, certain segments of the economy that are getting stressed. But there's other segments that, because of what happened in 20, never were able to get too far out over their skis. The balance sheets are still good. Their business never was able to ramp up since 2020. So, they're not seeing a whole lot of pain on the downside because, they never really got over their, got too far ahead of themselves. So this is going to be an interesting dynamic of what's going on.
It almost reminds me of that classic Goldilocks scenario. We're not seeing anything that dictates a trend.
Right. Exactly.
Things are good.
The one trend we know is, the Fed's increased interest rates. Yeah. I think that trend, my thought process is that's probably going to trickle over onto the longer end of the bond curve or the yield curve, mm-hmm. meaning longer term bonds. We still probably have room for those rates to go up a little bit. Maybe at some point the short end comes down, but at some point long-term rates have to be higher than short-term rates. So how that happens, we'll see.
We need a 30-year treasury at 6%. To get back to normal-looking
what they call
economic conditions.
Real interest rates, which is the interest rate minus the inflation rate, should be positive.
Yep.
And we're not there yet. That's what the Fed's driving towards. Inflation is definitely lower than what it was. Historically, inflation does not drop quickly. And we're definitely off the highs. I think we've seen peak inflation. But I think we're going to be in elevated inflation, mm-hmm. for a longer period. So getting to 2%, we may see it a couple times, maybe a month or two, or a month here and there, a quarter here and there. But I think the bigger trend is, I think we're going to see several years where we're in that 3 to 4% range, and it'll linger on before we see that a consistent 2% target.
Definitely.
Anything else on the economic front?
Let's talk about the portfolio.
Yeah, it was a great month for the markets. The Dow Jones for the month was up 2.8%. The S&P was up 6.2%. NASDAQ up 10%. Russell 2000, which is small cap stocks, up 9.75%. International markets participated. The developed world, measured by the MSCI EAFE, up 8.05. Excuse me. And the emerging markets up 7.8. So, positive returns across the board. Some would call it a bear market bounce. Who knows what that, if it is or not. The one reality is there was a lot of loss selling at the end of the year to capture losses, to minimize taxes, and a lot of the hardest hit stocks in 2022, a lot of them were sold off to harvest losses. Those are a lot of stocks that did very well last month. So
that's the NASDAQ being up 10%.
Yeah, exactly. The Dow, which was the strongest last year, up the least, up 2.8. So there could be some merit in that. Yet to be seen. We're not, counting on this as being all clear moving forward. We've seen a little bit of weakness the last couple of days, but then again, by the end of the day, it's kind of shaking out where, not a whole lot in losses. So, we're kind of moving into an interesting month here. Our portfolios, once again, we kind of participated in line. Growth with Income Fund, or portfolio, up 5.3% for the month. And, this kind of shows, where the strength and weakness was. NVIDIA, they got beat up pretty bad last year. Last month, they were up 34%. Nucor, actually, they didn't get beat up last year, just had a great month, up 28% there. Disney, once again, Disney caused us a lot of pain in 22, regained 25% there. And then Lennar, our home builder, kind of with Lennar, first part of the year last year was bad, strength into the end of the year, that strength has continued. So, that shows some signs that, maybe at least in the housing sector, it also shows some signs that the consumer is strong. The reality is the home builders were beat down so bad that, and I'm not talking about just last year, but over time, they haven't gotten a lot of love. They've kind of righted themselves, and it's not unusual to see them already turning well ahead of the economy. The laggards, J&J, down 7.5%, Pepsi down 5.3%, CVS down 4.7%. So kind of a stalwart from last year, giving up a little bit last month. Dividend yield portfolio, once again, our most conservative, looks a lot more like the Dow, up 2.5%. Blackstone, here we go again. Blackstone gave us a lot of pain last year, up 29% last month. LyondellBasell up 16.5%. Packaging Corp up 6.9%. Our laggards, Pfizer, which gave us some good performance last year, down 13%. Coca-Cola down 3.6%. Merck down 3.2%.
Well, and frankly, a lot of Pfizer is more headline risk.
Well, and that's the thing.
Project Veritas videos and stories that have come out.
And that's one thing we are seeing through earnings period. The reaction to earnings has been, I guess, accentuated, a little more volatile than usual. So, upon earnings announcements, we're seeing big movements in stocks. A lot of times the initial move is pretty big, then you kind of have things tapering a little bit, as the dust settles. So, the volatility is definitely here, especially through earnings season. Our appreciation with income portfolio up 2.66, kind of in line with the dividend yield. Lamar Advertising 12.9, Camden Properties up 10. Equitable up 11.7, Public Storage up 8.6. Once again, Pfizer down 13, CVS, another kind of held in both portfolios, down 4.7, Gilead down 2. Price potential, good month there, up 8%. Some of the gainers, Asbury Auto, which actually hung in there pretty well for a auto dealer, up 22.7. SS&C Technologies up 16.9. CarMax, which gave us a lot of pain last year, they recouped about 15.7%. FleetCor Technologies up 13.7. Only one laggard, Danaher, down 0.4%. So great month for price potential. In our small cap portfolio, lagged a little bit here, only up 4%. Haynes International, big gainer. PTC Pharmaceutics up 20%. Windmark up 19, Evertech up 14. Laggards, Clearfield down 24. Greene County down 14.75. Harmony down 12.6. So, once again, kind of to be expected. The rally was definitely driven by, a lot of the more speculative stocks, kind of a bounce back rally. Expectation wise, like I said, we could see a soft landing. We're positioned in bonds to take advantage of the higher short-term rates. Even if long-term rates rise, because we're in short-term bonds, we can always reinvest at the higher rates when they come due. So I like our positioning there. We're not going to get burned either way with whatever the Fed does with rates on the interest rate standpoint. And then in the stock market, the reality is we're sticking with quality. If we are really moving into a higher interest rate environment, we're in the stocks that are going to work. If rates do go down, our stocks will still work, as shown by the last 10 years. So I like where we're at. We're still holding on to our commodity positions, which, once again, should continue to do well in a higher inflationary environment. So, for the next month or so, I don't think we're going to see a lot of fireworks. But, volatility is always potentially out there, especially if, the economy deteriorates more. I think tech is probably still most at risk for maybe a final washout if it plays out that way.
So with that, we hope you have a great month. We'll talk to you again. On behalf of Kelly and myself, we just really appreciate your trust. Again, hope you have a great month. If you have any questions about your accounts, please feel free to give us a call.
Thank you.
Thank you.